If you think of the criteria that your typical lender looks at to qualify you for a mortgage loan, you quickly find that your credit score is a pretty major factor. In fact, your credit score serves as sort of a gateway to an application. If your credit score isn't at least a 500, many mortgage lenders will not move on to the income and debt portion of your application. So, needless to say, having a healthy credit score is pretty important. Today, I want to cover 3 new policies that have been circulating in the news lately. They have the potential to affect your credit score and thus your ability to qualify for a home mortgage. Hi friends, my name is Sylvia. Welcome back to the channel. I am a real estate broker in the Boise metro area of Idaho. I am also an investor of over 20 years, owning and managing property in California, Idaho, and more recently, Florida. I started Wealth Builders Realty as a means for growing my income, not just through real estate sales, but more importantly, through methodically buying, selling, and managing my own rental properties, thus building a profitable passive income portfolio. On this channel, I share with you my tips for buying and selling, how-to videos for managing property that rents well, and strategies I use to make sure that what I buy will continue to increase my net worth and build wealth. It is my sincere hope that these videos will be helpful to you as you commence the process to build your own generational wealth. If you are ready to get started in the Boise metro area, you can find our contact info in the description below. We look forward to sharing with you how Boise just might be the best place to get started on your real estate investment journey. Okay, back to credit scores and how our government and credit bureaus are seeking to change things up. In their words, for the better. First up, let's look at FICO's February announcement in which they state that they will now include data from buy now, pay later in their calculation of your credit score. Even though I had heard of companies like Affirm, Klarna, and even Afterpay, I really wasn't sure of their function as I don't personally use them. So I did some digging and found that, actually, these companies have been around for quite a while. However, their popularity exploded during our COVID lockdowns. They started as an alternative for credit cards for online retail purchases and have quickly moved into offering in-person options as well. In a nutshell, these companies offer a short-term loan on purchases, many times with very little financial qualification from the borrower, and typically with very little to no fees, making them a very attractive alternative to credit cards that charge you upwards of 25% for the right to pay that sum off over a longer term. With BNPL companies, you can spread out payments on specific purchases over weeks or even a few months. Further, many of these companies use soft credit checks, thereby protecting your credit score by not subjecting it to the hit a hard inquiry would cause. Most importantly though, these short-term loans are currently not reported to the credit bureaus, ensuring that their balances and payments are not factored into your credit report. But should this be important to you, and if so, how will it impact your ability to qualify for that next property? First things first, are you someone who uses this type of service? Well, a recent study found that a whopping 41% of US adults use some sort of BNPL service in the past 12 months. Of this 41%, 64% millennials said they used the service, 58% were Gen Z. Not surprising, baby boomers had the lowest number at 28%. Survey says, most likely user, someone under the age of 40 years old. Now, that is not a problem in itself, but stay with me here as I explain why I am concerned. The Federal Reserve reported that 18% of total users made at least one late payment, while a Motley Fool study found that number to be closer to 39%. So if this data is now reported, it has the potential to negatively affect more of the younger demographic. This younger crowd also happens to be the group with the least wealth in this country. Baby boomers own almost 52%, while millennials and Gen Z cumulatively own less than 10%. Add to that the fact that the majority of a person's net worth is found in their home, and you can see that anything that can negatively impact a credit score will affect someone's chances at building wealth. So if you're a millennial or Gen Z that plans to buy a home in the near future and you use BNPL companies frequently, you should be aware that this new reporting could affect your ability to buy. The primary effect is on your credit score. FICO and one of the BNPL companies, Affirm, conducted a major study over the course of a year to research the effects of adding this data to the average person's credit report. They found that in general, borrowers saw a modest improvement and no adverse impact on their credit score, which makes sense if you are the type of credit user who always makes your payments on time and pays the balance off completely. I did a video on what factors go into your credit score, and making consistent payments weighs in at 35% of your score. On the flip side, if you are in the 18 to 39% who have been late making a payment to one of these buy now, pay later companies, this new reporting system will now bring to light those delinquencies which were previously shielded from creditors looking at your report. And your credit score will surely take a hit. But even if you're a stellar credit user, there are two other implications for this new reporting system that are out of your control. First, it is not clear on how the short-term repayment plans on many of these products will factor into your average age of credit. The average age of credit, which accounts for about 15% of your score, refers to the average length of time all of your credit accounts have been open. This is calculated by adding up the age of each account and dividing by the number of accounts. In general, a good average age of credit is considered to be between 6 and 10 years. Well, if these short-term loans that can last anywhere from a few weeks to a few months are now factored in, will this cause your average age of credit to drop significantly, thereby dropping your credit score? And worse, if you're in the younger crowd with the majority of your credit being through buy now, pay laters, how will this be calculated? The second issue has the potential to be even more detrimental, as it will affect their debt to income ratio, DTI. This DTI ratio is a key factor in a mortgage qualification. The lower the DTI ratio, the less of a risk that borrower poses to the lender simply because there is more money left over to cover the debt. Not only will the addition of these short-term loans increase the amount of debt a lender must account for, but how that payment is recorded will also factor in. Let's look at a couple scenarios. A typical credit card will normally charge you anywhere from 1 to 3% of the balance, and in many cases, it's a flat $40 fee. So if you charge $500 on your Chase credit card, the monthly reported payment that shows up on your credit report would only be about $40. In fact, with that current calculation, you could theoretically spend up to $4,000 and still have only $40 reported on your credit report. On the flip side, BNPLs focus on micropayments that could happen weekly. In fact, Afterpay has a popular plan called Pay in 4. On this plan, you can buy up to a certain dollar amount and agree to pay it back in 4 equal installments, interest-free, over the next 6 weeks. If you borrow the same $500, that gives you a payment of about $125 due approximately every 1.5 weeks. If you took that up to $4,000, now it's $1,000 per payment. It will be interesting to see how these payments will show up on your report. The current reporting system shows only a snapshot of one point in time. So depending on when that snapshot is taken, there may be anywhere from 1 to 2 payments due that month. But even if they only reported one payment, that $125 is still 3 times more than your $40 credit card reported payment. You can see how this would quickly dig into your DTI. My friend, if you are prone to using these BNPL companies and want to buy a house, keep an eye on this. Let's move on to our second change, and that is that medical debt will no longer be reported on your credit report. The Consumer Finance Protection Bureau, CFPB, found that currently there is over $49 billion with a B in medical debt. And if that was wiped from credit reports, 1 in 5 people would see an average of a 35-point increase to their credit score. The argument being made by CFPB is that a $50,000 emergency surgery that you didn't cause and might struggle to pay shouldn't penalize your credit score, which is supposed to show how you manage debt. So how will this change your ability to buy? Currently, medical payments are not calculated into your DTI calculation, but they aren't hidden from a lender's view. And any late payments or debts sent to collections do affect your actual credit score. If the medical debt and any payments not made are no longer reported, then yes, your score has the potential to go up. But the bigger problem will affect those home buyers that are just at the mortgage qualifying threshold. The fact that you didn't choose to take on medical debt and that it is not reported doesn't negate the fact that it is debt that needs to be repaid. So if it is no longer reported, it will affect the lender's ability to ensure a borrower can truly afford that mortgage payment. The current mortgage application system does have checks and balances. Many Fannie Mae borrowers are put through an automatic mortgage approval system called Desktop Underwriter, DU. An application is submitted and an automatic program will spit out an approval for those who meet these specific criteria. And don't throw up any red flags. This system looks at the typical credit score and income and debt reported for the borrower. If you are not automatically approved for whatever reason, your loan application has to be manually underwritten. In this case, the loan officer and underwriter take a closer look at the file to ensure the borrower actually qualifies. So here's the problem. If this change is made, you will have a DTI ratio that will not include medical payments. But if those medical payments account for a significant portion of your paycheck, will your income be enough to pay for all your debts? So if you are planning to buy a home, even if your lender does not take your medical debt into their accounting process, you should. The last potential change I want to cover is happening at Fannie Mae and Freddie Mac. As you may know, Fannie and Freddie provide over 70% of the mortgage loans available to home buyers. And as the major mortgage providers that they are, anytime they change the way they calculate your qualification requirements, you should pay attention. Both Fannie and Freddie recently announced that they are moving away from a tri-merge method of calculating your credit score. Tri-merge refers to the blending of the scores provided by Equifax, Experian, and TransUnion. They are now moving to a bi-merge method that will utilize FICO 10T and Vanguard 4.0. Both of which take into account trended data. So what's really going on here and how will it affect you if you want to buy? Well, unlike the current scoring versions that only offer a snapshot of what your credit looks like at a specific point in time, these new systems will take into account data from the last 24 months to provide, hopefully, a better representation of your actual credit habits. For example, the current system will show that you make your payments on time, but it wouldn't reflect what kind of balance you carry month to month if you're actually paying that balance down, or if instead you continue to increase that balance. Further, if you think back to our buy now, pay later example earlier, a snapshot would not account for the fact that maybe that $125 payment will actually drop off in the next couple of weeks. It could also show what type of credit you resort to. Do you prefer longer terms to pay off credit card debt, or are you better at making small purchases and paying them off in a shorter time period? All this data will provide a better picture for Fannie and Freddie and anyone else who chooses to use it. Vantage 4.0 also brings some help to those with very thin credit files by allowing rent payments, utility payments, and even phone bills to be used up in building up your credit. So if you're young and don't have established lines of credit, or alternatively, if you prefer to pay for everything in cash, this factorization might help your score. And in fact, Fannie and Freddie reported that using this bi-merge method resulted in slightly higher scores for most borrowers. Of course, not everyone will benefit. If your trend data shows that you are consistently carrying high balances and never really paying them off, this could hurt your score and thus affect your ability to purchase a house. Also, while Fannie and Freddie are pushing for this new method, there is no requirement for any lender to use it. It is completely optional, which of course begs the question, should you be worried? Well, if you carry high balances and consistently make only the minimum payments, you might want to see what your lender will use to run your application. It might make a difference on whether you get approved or not. Friends, study after study shows that one of the best ways to grow your wealth is through real estate. And buying that real estate often comes with securing a loan. Knowing exactly what it takes to qualify is always important, and knowing how those requirements might change can certainly affect your ultimate goals. I suggest you stay on top of these changes and follow their implementation to see how they will affect you specifically. I hope you found this helpful. Don't forget to hit that like button and share with those who might be on the hunt for their next property. Thanks for watching, and catch you on the next one.